Hello friends, welcome to Marginal Costing Problem Solutions. Friends, for better understanding, before we move further, pause this video and read this question. So, hope friends you have gone through this question. Here we have information available about a company Suman Limited for 2 years 2016-17 as well as 17-18. Information contains sales and profit for both the years. From the given information, we are required to find out 5 points that includes PVR, fixed expenses, break even point in rupees, sales value when we want to earn profit of rupees 72,000 and to calculate a contribution when sales is rupees 5,50,000. So, let us friends solve this question. So, friends, first of all we will start with calculation of profit volume ratio. From the given information in the question, we can apply this formula for PVR, that includes profit difference of 2 period divided by sales difference of 2 period into 100. Here 2 period means years given in the question 2016-17 as well as 2017-18. Let us start. Profit of 2017-18 is 82,000 minus 64,000. Same way for sales 7 lakh minus 6 lakh 40,000. So, if we find out the difference, this will be like this, difference of profit 18,000 divided by difference of sales 60,000 into 100. So, finally, by simplifying this we can find out profit volume ratio, that is 30%. Profit volume ratio shows the proportion of contribution in the amount of sales. Now, next step, that is calculation of fixed expenses. For fixed expenses we can put this formula, contribution minus profit, but here we do not have contribution, but on the other hand we have PVR that we have calculated just now. So, as we have discussed, PVR shows the proportion of contribution in sales. So, instead of contribution we can apply this formula, sales into PVR minus profit. So, let us start for 2016-17 where sales is rupees 6,40,000, PVR 30% minus profit of 16-17 is 64,000. So, if we simplify this, we will receive fixed expense rupees 1,28,000. Friends, we can also apply the same formula for the amounts of second year, that is 2017-18. Let us see, we will receive the same amount. For 17-18, sales is rupees 7 lakh, PVR will remain same 30% and profit of 17-18 is 82,000. So, here if we simplify this formula, again we will receive the same amount 1,28,000 as a fixed expense. This amount will remain same in both the years because this is the fixed expense. The next point is a calculation of break even point in amount or rupees. For that purpose, we will use very simple formula, fixed cost divided by profit volume ratio. Fixed cost is already given in the question, that is rupees 1,28,000 divided by PV ratio 30%. So, if we divide 1,28,000 by 0.30, then we will receive BP that is 4,26,667. Okay friends, the next point is calculation of sales when the company want to earn profit of rupees 72,000. The formula we can apply to find out expected sales in the given profit is fixed cost plus expected profit divided by profit volume ratio. So, let us put the values. So, here fixed cost will remain same 1,20,000. We will add the expected profit that company want to earn 72,000 and divide the total of both by 30% PV ratio or 0.30. So, in this way by simplifying this formula we will receive answer, that is rupees 6,66,667, that is the required sale to earn profit of rupees 72,000. The next point is a calculation of contribution when sales amount is given, that is rupees 5,50,000. So, it is very easy to calculate contribution. For that we will apply this formula, sales into profit volume ratio, because PVR shows the proportion of contribution in the sales. So, here we can say that 5,50,000 into 30%. So, here contribution is rupees 1,65,000 when the amount of sales is 5,50,000.